Luna, TerraUSD, Three Arrows Capital, Celsius. In a span of 2 months, a stablecoin collapsed. A hedge fund managing $10 billion of assets filed for bankruptcy, along with a crypto lending platform that still owes 1.7 million users $4.7 billion. But that's not all. Genesis, Voyager Digital, BlockFi, and many more face hefty losses, with Voyager also declaring bankruptcy from exposure to Three Arrows Capital, which was dragged under by the fallout of Terra.
A domino effect has been unfolding in the crypto market caused by overhedging of stablecoins, poor risk management, and unsustainable yields. Losses are growing and many firms are being pushed to bankruptcy.
How did this happen? Can crypto recover from this credit crisis? Are stablecoins actually stable? Stablecoins like USD Coin are backed by USD-denominated reserves or reserves of cryptocurrencies, with transparent disclosures available online. But Terra is not backed by actual reserves. It relies on an algorithm that adds or removes tokens from the supply to maintain its peg to the US dollar.
There were a number of macro factors, for example, the Russia-Ukraine war and the Fed raising interest rates. All these factors contributed to the crypto market slump. During this time, there was a massive sell-off of the Terra stablecoin, which caused it to dramatically lose its peg to the US dollar and become worthless. But what caused this crash still remains unclear.
The $40 billion collapse of Terra rippled across the crypto economy. Almost $300 billion worth of cryptocurrencies was lost in that period, and nearly 2 trillion Singapore dollars in crypto has been wiped out since November last year. Multiple bankruptcy filings have exposed the rampant recursive borrowing and capital recycling in the crypto space. Yield rates as high as 17% drew investors in. Traders then borrowed heavily and took multiple loans to hedge and stack their returns to meet the high returns as promised. This is known as recursive borrowing.
When lenders fled their risky assets during this crypto contagion, it led to funds and exchanges not being able to meet margin calls as liquidity was depleted. Many customers' accounts were frozen to prevent further bleeding. For example, Celsius loaned out deposits from investors and it had $500 million on the Anchor protocol, which is the platform for Terra that promised investors 20% in annual yield. Multiple companies had exposure to Three Arrows Capital, which invested heavily in Terra, so the stablecoin's crash led to more losses and bankruptcy filings.
This also shows how capital is heavily recycled in the crypto space, where risk is concentrated in the few high returns assets that were vulnerable. In any financial market, while lenders and borrowers create risk and leverage, regulations protect retail investors and manage risk. But in an unregulated environment like crypto, retail investors are left to fend for themselves. So, is regulation the answer? Sam Bankman-Fried, CEO of FTX, a crypto exchange that trades over $2 billion daily, certainly thinks so.
So I think getting regulatory clarity is huge, and I think it's good for everyone. I think it gives customer protection that we're missing right now, real federal oversight, protection against financial crimes, against systemic risk, and at the same time allows the industry to move back onshore and bring real liquidity to US markets.
But in reality, implementing regulations is much more complex.
Most crypto regulations focus on anti-money laundering and countering terrorism financing, but there are very few regulations focused on consumer protection and market conduct. Right now, regulation is still catching up to crypto trends, so the MAS has plans to regulate and strengthen consumer protection, but its stance remains clear that crypto is highly risky and that retail investors should steer clear. It needs to balance supporting innovation on one hand and regulating to manage risks on the other. Industry players have suggested, for example, higher capital requirements, more transparency and checks on the tokens that are listed, separating customers' assets from the exchange's corporate funds, and also having rules against insider trading and for market conduct.
Any form of regulation, however, will take time. The Japan Virtual Currency Exchange Association was set up in 2018 to self-regulate the crypto space in Japan. Currently, it takes 6 months to a year for a single token or coin to be reviewed. Not much has changed 4 years on, with little to no regulations put in place. The fallout looks bleak. Trillions lost in value. Bitcoin plunging below $20,000. Thousands of crypto employees laid off. More companies are filing for bankruptcy with liquidity running out. The previous crypto winter stretched from 2017 to 2020 until the pandemic saw an influx of new investors and a boom in the space. But bailouts might not be the answer either. FTX has a deal to acquire BlockFi at $214 million, a far cry from its $3 billion valuation. While Alameda Research, also owned by Sam Bankman-Fried, is trying to buy out Voyager Digital. But Alameda Research is also a creditor, borrower, and a shareholder of the company, which shows how closely these companies are connected and how leverage can be abused. And why regulations might be the key for the crypto industry to move forward.